Alright friends, now we'll look at something called capital accounts and how we draw them up. Say capital accounts consists of the original capital put into the firm by the partner, and it also consists of the share of profits, interest on capital if any, salary if any, less interest on drawings if any, and the drawings themselves. In other words, this is really the amount of undrawn profits. We can have an account for each partner which would contain both kinds of information. The balance on this account would fluctuate each year as drawings very rarely exactly equal profits. Because rarely drawings equal profits, right? That is true. This would be like a capital account in the sole trader's business. These balances now, because they fluctuate, they are called fluctuating capital accounts. On the other hand, we could keep the original capital figure in an account for each partner. These we would keep at the same figure, and we would call these fixed capital accounts. Now we're going to look at the fixed capital accounts plus the current accounts as well. We would show the share of the profits and interest on capital for each partner in what? Separate accounts called current accounts. I repeat, we will show the share of profits and interest on capital for each partner in separate accounts called current accounts. Each of these methods can now be shown using the example already seen of Taylor and Clark. So when we use again Taylor and Clark, we're going to assume now that the drawings for the year is $2,000 each. That means it is $2,000 for what? Taylor and Clark. Now, let's go. First thing we look at, notice now that the capital account for Taylor is $2,000 because we're looking at the fixed capital accounts. So here we have $2,000 under the fixed capital accounts. Alright, next we have something called, we have Clark capital account, and it is fixed also, just like as usual. You know that capital account is credited when there's an increase in capital. So this is the same case. $6,000. This $2,000 is coming from the question that we did before. So if you see, I hope you still have the question sheet. So you look back at it, you realize that the $2,000 is coming from the question, because the question said that Taylor have capital of $2,000 while Clark have a capital of $6,000. Alright, now we'll look at the current account, how the current account is structured. The first thing that we do as it relates to the current account is that we bring down the cash, the drawings, and these drawings come from what? We assume that $2,000 drawings for each partner for the year. So that 2,000 comes here. So right. So we're going to enter at the last date of the year, of the period of recording for the partners' accounts. So it is $2,000 cash drawings, $2,000. Then we would debit the current account with the interest and drawings. So with our profit and loss appropriation account, interest and drawings, $50. This comes from what? This comes from the appropriation account. So in the very appropriation account, remember to focus on the interest and drawings. We debit the interest and drawings in the what? In the current account, right? However, we credit the interest and drawings in the what? In the appropriation account. You remember that? Alright. So we debit interest and drawings in the current account. We debit the current account with interest and drawings from the profit and loss appropriation account, and then we go to the other side now. We then credit the current account with the interest and capital from profit and loss appropriation account, which is what, $100 coming from the appropriation account that you did before. Share of profits is what, $2,550. If you look on your let me go back to it for you. Remember this? Share of profits for Taylor is what, $2,550. So this is coming from our appropriation account. Remember that. Alright. Yes. So this is 2,550. When we add these two, we get 2,650, and we have these two over here, we get 2,050. Then we would then subtract the smaller from the bigger, and then you get a balance carried on of $600. So please note now that the date for each transaction will be recorded at the last, because what, we are doing an overall thing, so we record using the date for the last, the last date of the recording, of the period of recording. Then look at the current account for Clark. As usual, the first thing we do is bring down the cash drawings, which is $2,000. So we're going to debit the current account with what, cash drawings of $2,000. And as usual, we debit the current account with interest and drawings from the profit and loss appropriation account, which is $100. We then credit the profit and loss appropriation account with interest. No, we credit the current account with interest and capital from the profit and loss appropriation account, which is $300 for Clark, as you may remember. Hope you do. And then we also credit current account with the share of profits for Clark, which is $1,700. We also credit the current account with the salary which was scheduled for Clark, $500. We would add up everything. We get 2,500. When we add the 2,000 cash drawings plus the 100 interest and drawings, we get 2,100. Then we subtract the smaller from the bigger, and then you get $400. So it's balance carried on $400. Alright. That's how we do the fixed, that's how we record as it relates to the fixed capital accounts, recording. That's how we record as it relates to the fixed capital accounts. Now we're going to look at the fluctuating capital accounts. The distribution of profits in this case will be credited to the capital account. And the drawings and interest and drawings will be what? Debited, as was done before. Therefore, the balance on the capital account will change each year. That is, it will fluctuate. If fluctuating capital accounts had been kept for Taylor and Clark, they would have appeared as follows. Now, we are looking at fluctuating capital account for Taylor separately. So you will have $2,000 cash drawing, because you say we're going to what? Debit drawings and interest and drawings, $50 interest and drawings. We're going to credit capital account with what? $2,000, which comes from the capital, which is which is what was recorded as capital before. And then we would also credit capital account with interest on capital, which would be $100, and we would also credit it also the share of profits, which is $2,550. So look at this now. When we add up everything, we get 4,650, and when we add up these two, we get 2,050. When we subtract the 2,050 from this, the smaller from the bigger, we get 2,600, which is called balance CD. Notice now, note that in this case, we use the last date for the last, right? And we use the for the first for this one, because what? This is when money was first injected into the business by Taylor. So this came in at the 1st of January 2007, and we record at the first in that case. Remember that one. Alright, and then balance BD. It should balance BD. Sorry about that. It should be balance BD. Yeah. So that is 2,600. So you see that the capital fluctuates because what? Because what? The profits and the drawings are not necessarily equal, right? Look at this now. Drawings is 2,000. Profit is what? 2,500. Suppose it was 2,500 for the other year, and profits are 3,000 for the other year. See, it fluctuates, my friends. So therefore, because it is not the same, it fluctuates. Drawings and profits are not the same. That's why we call it fluctuating capital accounts. Alright. Next, we look at Clark's capital account and the fluctuating capital accounts. So first thing, as usual, we bring down the $2,000 cash drawings, and then we, as usual, we would debit the capital account with interest on drawings. So we debit the capital account with cash drawings and debit the capital account with interest on drawings. We credit the capital. We then credit the capital account with the money that was invested, which is $6,000 invested by Clark. Then we credit also the capital account with interest on capital, which is $200. We credit this account with the $1,700 share of profits, and we also credit the capital account with a salary of $500. In this case, we call it is 8,500 is the total. Then we're going to subtract the lowest from the smallest, and we get 6,400. Alright, and you can balance BD. This is balance BD. Sorry about that. Supposed to be balance BD. So that's it for that. These accounts, whether fixed or fluctuating, could have been shown in columnar fashion. We will illustrate this in the following videos. You can see that all that has happened when drawing up columnar capital accounts is that the accounts for each partner have the figure displayed in separate columns instead of using separate accounts. In this case, we use separate accounts. In the other video clip coming up, we're going to use them we're going to do it in columnar fashion, which is the fashion that you are encouraged to do it with in your CXC exams.